Welcome to Subramani. I recently saw and read a book, very short book. In fact, it's saying Rethinking Investing, a very short guide to long term investing. Why did I even pick up this book? Because the book is by Charles Ellis. This man has written another book which I have read, which is Winning the Loser's Game. That's a very good book. But what the problem with this book, like many other books, is they think that there is one size fits all in investing, and that's not true. Largely, if I have to give you a one line summary of this book, it says be frugal and you will get rich. Right now, this is not a new theme. The millionaire next door was a theme like that. Right, it said what the very rich people do, what millionaires do, they buy used cars and stuff like that. Right, so this book is also like that, and I would call it one of the classical books in the sense that it's very clear and it is very precise in what it's saying. For example, it says you don't need fund managers, indexing will work. I partially agree with this because as more and more good fund managers arise, and they start pulling, let's say the index has 30 companies, right? The Sensex has 30 companies. One fund manager knows how to create value. He picks up 17 of those companies and does it. Another guy picks up another 14. Another guy picks up another 16. Now, all these people are pulling the index from various directions. So, all of them will anyway go and put money in, say, HDFC Bank or things like that, or Reliance, which are heavy weights in the index. But somebody could say, no, I'm playing contrarian. The shares which have got too much weight in the index, I will ignore. So I will not buy Reliance, I will not buy Infosys, I will not buy HDFC Bank, but I will buy the laggards. So various ways of dissecting the same thing. So when you do that, it becomes very easy for the index to outperform the market, because all these guys, one year one of the guys will get alpha, other guy B will get alpha, then C will get alpha. Every year the guy getting alpha will change. But if there are, let's say, 140 large cap funds, or 150 large cap funds, the index fund will always be number 7th or number 8th. It will never be number 1, obviously, nor will it be number 140. Both can't happen, because all the other 140 people are investing in those same 30 companies. So will you make money in the index? Yes, if you're not an active investor, if you don't want to pick up stocks, if you don't want to pick up good fund managers, index will make you money. Will index make you more money than PPF and State Bank of India fixed deposit? Answer is yes, it will make more money. Do you want to be actively involved? Do you want to say, no, it does not matter to me at all? Then indexing works. But if you say, no, I think I'm competent enough to pick up some good fund managers, some stock picks, and I will put some 50% of my money in the index, that will also work. Today in India, why pure indexing will not work is because, suppose you have 100 rupees and you decide to put 50 rupees in the bond index and 50 rupees in the equity index. Simple, right? Very simple indexing. Unfortunately, the bond index is being taxed at 30% at the highest slab, maybe 30. This 30% is a joke, because after including surcharge and all that, you come to more like 34%. So you will be paying tax at 34% on your bond. And you will have to do bond market also, you will have to do some timing. Whereas if you put your money in a multi-asset fund, it's going to be far more tax efficient. So a big portion of your money can be in multi-asset fund or a balanced fund where there is debt and equity. Will gold make money for you in the long run? Very difficult to say. So the core message is that investment landscape, the core message of this book, Rethinking Investing, is that the landscape has changed. So 50 years back, you needed active fund managers. Today, you don't need active fund managers. But Today, I think you need an advisor to pick which ETF to put because there are just too many ETFs. So I would go one step further and say, do you need a financial planner? Do you need an advisor? The answer could be no for maybe 5% of the population, but yes for 95% of the population, because they have to be told many of these things. Start early, do compounding, live frugally, at least in the initial stages, because the initial stages, what you save and invest is far more important than what return you get, right? So somebody has to say all this. The core message uh, is the skilled participants are pulling the index from various sites, so you will indexing will work for you. But I know I've had this discussion with people like Parag Parekh, Naren, etc., saying their alpha creation will not go away. I mean, I have an equity portfolio where many of my shares are outperforming the index, like say Siemens, Cummins, Coromandel International, right? So, but there are some shares which outperform the index, which may have outperformed the index in the last 5 years, but may have underperformed the Sensex in the last 15 years. Something like say Colgate. But does it mean I'm going to sell Colgate to buy Asian Paints? Am I going to do that? Answer is no. I don't need to do that because I'm very happy with the dividends that I'm getting from Colgate and HUL. So there will be some people who will never want to look at their portfolio on a day-to-day basis. So this book is not really applicable to them. So the paradox of skill, that more and more skilled fund managers who come, more and more it will become easy for you to make money on the index, right? So indexation should work. So typically some of the principles which are not something new, right, is frugality and compounding. Save aggressively by cutting unnecessary costs. For example, avoid latte. Buy used cars. Buying used cars is a very sensible idea for most people. If you want a car, you might as well buy a used car. You get cars which are say 40,000 kilometers old. People who have used it for 5 years, 6 years, but not had much running. So these kind of cars are available, especially if you are living hand to mouth, in the sense your annual income is about 15 lakhs, 17 lakhs, and you want to buy a car. Used cars make more sense. When you're in the 2 crore per 3 crore kind of income earning, then this saving 5, 10 lakhs, 20 lakhs on a car does not really matter. So, and if you have long spanning investments, so one more thing, at least in the Indian context, is to say, I will withdraw only when there is some major change that is happening or when I need the money, right? So, because every churn costs you money. Remember that. That's very important. Every churn costs you money, especially if you are in a PMS. If you are in a PMS and it's an active PMS, it's very difficult to make money after taking away the short-term capital gain and the fund management costs and all those things. After that, to make money in an active PMS or in an active portfolio is not going to be very easy unless the PMS itself is a low churn PMS. So if you're going to talk of 60 to 100 years of investing, then through potential life spans of 100 years or longer, saving money makes sense. Ellis illustrates this with examples like the rule of 72 and warns that missing the market's best days can slash returns from 11% to 9% annually, right? So obviously some of the data that he has taken is from the websites, etc. I'm not quoting that. And then he has dedicated one chapter to behavioral finance on concepts like Daniel Kahneman's thinking fast, thinking slow, to explain overconfidence, optimism bias, and emotional reactions. Today, if I go and tell people that you will get 7%, 8% return in the multi-asset fund, people are going to laugh at me because last year multi-asset funds gave 23% return. Now, this 23% return may have come on the back of 50% return on 15% of the assets, which was gold. Will gold repeat 50%? Answer is clearly no, because it cannot do two consecutive years of 50%. So will 50% be followed by 5%? Will it be followed by minus 5%? Will it be followed by minus 10%? We have no clue, right? So those kind of things are there. So then there will be this emotional reaction. Subra, you're wrong. I think multi-asset will give 14% return. Fantastic. Therefore, funds, individuals tend to underperform because they'll stick around in the fund which can't perform. By definition, some of these funds can't perform. Some commodity funds can't perform. But you in another commodity, you may be at the start of a cycle, right? So, if you take all those studies by Morningstar, Dalbar, etc., indexing might help mitigate some of these things by saying, okay, I will once, because I'm indexing, I don't have to worry about fund management change. For example, recently in India, one fund manager has quit, and she's going somewhere else. She's going out of the retail space. So if money has been allocated to her, you have to wait and see how the new fund manager is performing there. He's got a fantastic track record. Having said that, whereas if it was indexing, you wouldn't have to bother about the fund management change. So then have a look at your holistic portfolio view. Rethink says allocation by including non-securities like home equity, which will be like a stabilizer to your portfolio. That's the word you use. And social security, which will provide for an inflation protected government annuity. He says that you don't need a debt fund. I mean, that's a fantastic statement that is made in the US. So he has said go for indexing. You don't need a bond fund. So he says yes to commodity maybe, and he says you are anyway building home equity. So there is some debt kind of portfolio getting built there. So the age in bonds and all don't really make sense. Exceptions, of course, are there, such as funding college tuition over a very short period. If you got another 3 years to go for college tuition, that money should not be in equity. So that money has to be in debt. You can't afford to put it in gold bonds or stuff like that. Then some practical retirement strategies. Is saying for those nearing or in retirement, focus on sensible spending rules, optimize social security, because it's very important for you to know when to start drawing from a social security. Should you draw it at 65? Should you draw it at 67? Does postponing it to 70 help, right? So between husband and wife, you postpone one and you draw the other. Some of these things. Of course, he goes and bashes up and he says you don't need endowment insurance, you need only term insurance, and invest the balance. Overall, I think this book is not saying something new. There is nothing in this book which you will not find in my videos. It may be in different parts. So putting everything together may make sense. Overall, the book positions indexing as the winner's game. I'm not so sure, because I see a lot of people who are able to create alpha also. And also, after a particular point, does it really matter whether you're beating the index, not beating the index, beating the fund manager? Doesn't matter. Suppose you need 3 crores for retirement and you have 15 crores. Then for you, investing is more fun rather than saying, oh, if I don't perform well, I won't get money. That is for the fund manager to worry about, not for you and me to worry. We can just invest wherever we want, underperform, overperform, outperform, get dividends, live on that comfortably. That's what we are lying. We are trying to use our investments to meet our goals. If you can do that, you don't need this book. Thank you.